Welcome to Hargreaves Lansdown's Meet the Manager. I'm Joseph Hill, and today I'm joined by Mark Niznik, co-manager of the Artemis UK Smaller Companies Fund, which features on our wealth shortlist of funds selected for their performance potential. Mark, you run the Artemis UK Smaller Companies Fund, which invests in smaller companies across the UK stock market. But you've got a valuation-based approach, which is quite different to some of your peers. So tell us more about how you invest.
Thanks, Joe. Certainly thank you for having me to start with. 80% of UK small cap funds are more growth oriented than the overall small cap benchmark index. Will Tamworth, my co-manager, and I deliberately try to position our fund differently to others in the market. So we have a very strict valuation discipline in the companies that we're investing in. It's very easy to get carried away with the hype of a really good story in this sector, and our valuation discipline helps protect our investors from that trap, and we think it gives us better returns over the long term.
And smaller companies can offer lots of growth potential to investors, but they can also be higher risk. Are there any sort of red flags you spot when you look at a company and think, actually, that's a company to avoid investing in?
Yes. A consistent lack of cash generation is a big red flag to us. So cash flow can be a great predictor of companies that might be getting into a little bit of trouble. And so Will and I have an absolute focus on the cash generation of the companies that we're looking to invest in. Now, many investors will focus on profits and earnings, and that will be their focus. We again try and be a bit different to that in what we look at cash flow. Cash flow is very difficult to fiddle. Profits are easier to fiddle. We think by focusing on cash flow, we avoid getting into an accounting sharp practice or scam, and that helps protect, again, our investors from falls in share prices with those situations.
And in the UK stock market, we've seen lots of takeover activity in recent years, and at the same time a slowdown in the number of IPOs coming onto the market. So as a small cap investor, how has that changed the opportunity set for you, and where are you excited about at the moment?
Yeah, I think Will and I see takeovers and IPOs as two sides of the same coin, and that is very, very low valuations in the UK stock market and even lower in UK small cap land. So if you're an entrepreneur, you're not going to want to IPO your business at a very low price, a very low valuation. So hence the dearth of IPOs. And similarly, takeovers are going to happen when valuations are low. So we've had 32 of our companies taken over in the last 6 years at an average 47% premium. So low valuations are very good news for investors because it allows them to benefit from the pickup if those companies get taken over. And the other thing I'd point out is it's undeniable that as companies get bid for and IPOs aren't happening, that the available pool of investments is reducing. But there is still a huge amount of choice in the small cap market. There are over 1,000 quoted companies in the small cap landscape. Maybe half of those are investable. So we've got 500 companies to invest in. There's lots and lots of choice. And at the moment, that's very exciting because valuations are so low.
And interest rates are much higher than they have been in the relatively recent past. How are the smaller companies you're invested in the fund dealing with that challenge of higher rates?
I think one of the misconceptions is that smaller companies have very leveraged balance sheets. That's not the case. Smaller companies have very strong balance sheets. If you look at the median holding in our fund, it has no debt at all. So those companies aren't having to suffer from high interest rates on their debt. I think the notion that small caps are highly sensitive to interest rates is much overblown. What is important is domestic economic confidence. And what we've been lacking in the UK is confidence. Confidence for consumers to spend money, for companies to spend money, and for investors to buy shares. And our perception is that it will only take a very small change in confidence for there to be good returns for investors. It will only take it being a little bit less bad in terms of a macroeconomic future to make some really good returns in this sector.
And Mark, you've spent your career investing in UK equities. What top investment tip have you picked up along the way that might have been useful for you to know back when you started out?
Very simple. Don't look at adjusted earnings, look at cash flow. That would have saved me a lot of money.
And who would you say has had the biggest influence on your investment approach?
My dad. So my dad taught me the importance of listening. A lot of people, especially in this industry, talk a lot. And you don't learn by talking, you learn by listening. So listening intently to what's being said has really helped me in my career. At Artemis, I'm surrounded by some very, very clever colleagues. My colleague Will, the colleagues in the UK, US, the bond team. There's a lot of clever people at Artemis, and I listen to them. I also am very privileged in that Will and I get to meet management teams who've grown businesses from nothing to some really great businesses, and we get exposure to them. And so we listen to them and we try and absorb some of their knowledge by listening. It's very important.
And outside of work, how do you switch off?
I would say playing games with my family, so board games, so that the favourites would be Uno, Quirkle and Bananagrams. I tend to always lose, but my daughter tells me I'm having a good time. So that's the way I switch off.
Great. Mark, thank you very much for joining us.
Thanks very much, Joe. Appreciate it.